Welcome to the CU 2.0 podcast, greatest hits number 26. On the podcast is Kirk Kordeleski, one-time CEO at Bethpage Federal Credit Union and one of the industry's most perceptive thinkers. On this show from November 2022, Kordeleski muses what he calls the 5 generations of credit union CEOs. And he also offers tips on surviving a recession. That's advice that very well may be timely. Listen up. This is the CU 2.0 podcast with your host, Robert McGarvey. Big new ideas about credit unions. CU 2.0 podcast. Today's credit union leadership, especially at the nation's best and biggest credit unions, but at many others too, is professional and deeply versed in financial services. But that wasn't always so in credit union land. In this episode, Kirk Kordeleski, one-time CEO at Bethpage Federal Credit Union, one of the nation's biggest and now an executive at OM Financial Group, which specializes in SERPs, which are building block retirement plans for key credit union executives, giving us a history lesson on the 5 generations of credit union leadership. He starts way back when everybody was a volunteer, everybody. It takes us to today where we now are moving to a 6th generation of post-baby boomer leadership. With each generation, the leadership gets more professional, more skilled, more competent, more strategic. Then that takes us to the next topic, which is a challenge in many credit unions: budgeting, payroll in general, executive salaries, and total comp in particular. What Kordeleski says boils down to this: in most cases, nowadays, you get what you pay for. And today, credit unions need exceptional leadership as we shift into an environment of inflation, possible recession, and where liquidity is a key, but liquidity often is hard to come by. Strategic, clever, agile executives are the key today. Remember, this is the one-time CEO of one of the nation's biggest and most aggressive credit unions, and he is offering what amounts to free consulting insights. Take notes. It's all good stuff. You may not always agree with Kordeleski, but you will learn from him. Listen up.
I have a theory on community banking that it's going to be overwhelmed by the credit union aggressiveness in the marketplace. And when we talk about the different levels of management now, this trend over the 5 to 6 generations of management that we've seen in the credit union industry, that this last generation is doing all the things that mature companies do, and with some advantages in the marketplaces that credit unions have.
Yeah, I agree. I think community banks are pretty irrelevant to credit unions at this point. I find it funny in a sad sort of way that community banks are obsessed with credit unions as the boogeyman. And that's because their trade associations, much as the credit union trade associations, like to stir up fear as a means of keeping members in the fold. But when I look at the numbers, the threat to credit unions is big banks and fintechs. Community banks just aren't relevant in most markets.
That's it. I couldn't agree more. I think it's been on that trend for a decade. But it is amazing to me about the effectiveness of trade organizations of stirring up enough fear to get people concentrating on it. Now, I am a big supporter of NAFQ and CUNA. I don't want anyone to mishear what I just said. But at the end of the day, I would argue passionately that credit unions are not likely to be taxed, and I would argue passionately that for community banks, that they're losing market share to their regional and super regional and national banks, not to their local credit unions, because our market share isn't growing aggressively. Yet we're the number 1, number 2, or number 3 item on each of their lists to push for us to be taxed. So one way, it's never going to. I can't see a situation where Congress would tax us unless we get down to too few credit unions. And on the other hand, the biggest problem for community banks isn't credit unions. It's a fascinating situation to watch.
Yeah, some years ago, I was at GAC and I was talking with a handful of board members from tiny New England credit unions. And I asked them why they'd come to GAC. And they, to a person, said to walk the hill to protest taxation of credit unions. And I said, there's no way in hell anyone's talking about taxing you. I didn't get it. Yeah, Bethpage should be afraid of taxes. A $50 million credit union in rural Vermont, all of Vermont is rural, doesn't have to worry about taxes.
Yeah, you could. That's a great point and very thoughtful. If you look at the $1 billion class or the $10 billion class, there's some vulnerability for taxation. I still think two problems with creating a taxation for credit unions. One is just not enough dollars, right? There's just not a major hit to the government, a major positive impact of taxing credit unions. And there is an incredible negative reaction that would occur from the 100+ million members who could get, like in HR 1151, pretty motivated, but certainly the credit unions and the trade associations would. The second piece is that as you think about the government's view, that both political parties view, there's no inclination to tax credit unions, right? So it's both of those things, I think, stand in direct opposition to the situation that we're likely to be taxed. But the larger credit unions are a bit at risk. But the point is, what's interesting, Robert, about the larger credit unions, and now I have a bias towards this, so I'll admit it up front. But the largest credit unions really do their best to walk the walk, meaning that they provide great member value, better rates, lower fees, very effectively oriented towards service. And if you look at Suncoast and BECU and North Carolina State and Navy, and they're Penn Fed, Alaska, these guys, First Tech, these guys all really provide a value. I mean, look at Alliant Credit Union right now and their dividend rates. They're uniquely living the philosophy as well as running a business. So I think it's hard to argue that they're not giving back to their members. Suncoast, Schools First do these amazing jobs of what they do in their communities and how they support the teacher populations, truly give back to their primary employment groups. First Tech is beautifully modeled around the tech employees in the West. It's just the credit unions that get it right, Robert, really are capable and managed and have executive management and have strategy that marries the philosophy of credit unions and running a business. Frankly, the ones that are not as effective, don't grow in essence, are the ones that are all philosophy and no business, or the ones that are all business and no philosophy. We have a reason for existence. Managing to that reason for existence is what helps you grow.
Well, last time I looked at the numbers, the biggest credit unions had significant asset growth, and smaller credit unions had no asset growth. That reflects the talent and expertise of the management in many cases.
Right. Absolutely. That leads us into our conversation today, right?
Right. It's the fifth generation of credit union leaders. There's been the metamorphosis from volunteers who might or might not have had any financial relations skills to today's professional people. And in the biggest credit unions, these are very professional people.
That's right. Yeah. So, I've thought about this a little bit. It's not deeply researched, so I don't want to suggest that there is these delineations that I'm about to talk about are absolutes or accurate. And there's certainly credit unions in each one of these generations that would have shown exceptional growth or had very poor performance. But, if you think about it in terms of both years, strategy, and management, and I think they all go, particularly the latter two, go hand in hand. if you think about the 30s to the 50s, it's really when the generation of credit unions started to get created, and not only on a federal basis, but certainly state basis beforehand. But these were organizations run by volunteers. I mean, every credit union in the country, I think, has a story, a mythology around, my little favorite place in the world, Bethpage Federal. Some 30 members getting together, putting $3 each into an account and starting the credit union. And those organizations then, were run literally by the volunteers that came up with the idea and managed it. And if they were connected to a sizable organization, in Bethpage's case, Grumman, and we've talked about a couple of large school systems in Suncoast and Schools First, or of course Navy and Penn Fed and the military, then those credit unions have got a lot of small amounts coming in. They gained some reputation. Typically, they also had a direct relationship with the management of the select employee group, the SEG that they worked with. Very quickly established that relationship, often with the human resources department, as a benefit to the company. And then as people joined that company and that company grew, they became members of the credit union, and a deep connection was created between that organization, that single organization, and the credit union management. That kind of led to, sort of 50s, 60s kind of time frame, something around those times, where you started to see administrative management. There might be a couple of employees. They were coordinating that connection to the that single employment group. They were starting to think about additional products beyond savings and unsecured loans, maybe car loans, probably, maybe a larger unsecured loans for remodeling or for a new refrigerator or whatever it might have been. But the loan dollars started to grow. But the essence of the organization was it was still a monopoly that was being run. It was still deeply connected to a single SEG. Its strategy was about reaching out to the employees of that credit union's membership and that employment base of the single SEG. And it was very, very directly oriented to just administering X and Y. The conservativeness of lending has come out of both of those generations of leaders. They had very little expenses, right? They didn't have marketing expenses. They didn't have technology expenses. They didn't have a lot of risk because they knew that people were going to be, they knew who they were lending to. They knew how much they were paid and how long their employment might last. And they gave loans that were around that structure of a monopoly and conservativeness and direct line of understanding of the business.
In many cases, they didn't pay rent either.
Correct. No, great point, right? They hardly had any expenses, right? They didn't pay rent. They didn't have
they didn't pay electricity.
Correct. Exactly right. So it was, and I think it's really important to think about those first 40 or 50 years of how credit unions operated and how it still bleeds over to today's concepts of risk and markets and strategy. And when I touch on the third and fourth generation, I'll talk to you about really how much growth was disdained. It was thought to be something bad. So yeah, these first two generations were volunteers, general admin managers, often, came employees directly from the SEG itself, and not necessarily very high-level employees that moved over. Not a lot of business orientation, a lot of service and connectivity to the organization orientation.
Recently, say 10 years ago, I talked with a few credit unions under 100 million in asset, I think probably under 50, where they had one paid employee who had a title like general manager or something like that. This was not a highly paid employee, someone who turned the lights on in the morning. And oftentimes it was still free rental space. Free office space.
That is certainly the delineation between asset sizes that exists to this very day. And, this is one of the arguments or discussions or problems that occurs in talking about saving the smaller credit unions. There's a philosophical argument about how important these credit unions are, and they are. There is a point of discussion that goes back to the earlier part of this conversation, that if you get under a certain number of credit unions, it is problematic to keep a separate regulator, and it may be problematic for taxation and other issues. So the smaller credit unions matter a great deal. Some of them are exceptional and run by exceptional leaders. But for the most part, they still exist in these early phases that we're talking about. They exist as a monopoly. They are not thinking about strategy. They do not have sophisticated financial analysis. I mean, we'll see a number of them exposed a bit as interest rates go up, and they have their investment portfolio in lower rate investments that they put their excess liquidity in for the last 5 years. And, that's going to be pretty severely underwater. And it's going to be a structure that the lack of all of those skills makes it very difficult for those organizations to survive. And many times they're not compensated fairly either for the complexity of their business. So the smaller credit unions are really stressed to have the skills. I mean, it's a tough job, right? Those guys have to manage, the leader of a small credit union has to manage so many different aspects of the business that larger credit unions, senior teams would never think about having to touch.
And I believe, if I remember correctly, what Kuna told me, the majority of the CEOs in those smaller credit unions do not have a retirement plan. None.
That is right.
And they might have one that they set up personally, but the institution has provided nothing.
It's interesting you bring that up. I'm working on a white paper right now for credit unions $70 million and above. And the cutoff for that is based on annual compensation, based on the Qs and CUNA studies of how much those credit unions above $75 million make a year. There's about a $200,000, if you will, where Social Security and some level of 401k payments can create a fair retirement program. Above $200,000 or so, you need to supplement that retirement. And that comes at about $70 million to $100 million in assets that those credit unions leaders are making those dollar amounts. We're still testing that data. It feels like that's still a little bit of high income, but that's where the data is today. And so we've written a white paper to present to a couple of the small credit union organizations to discuss what SERPs might look or retirement plans might look like for those credit unions, so that those leaders can stay within their organizations. Because the biggest risk is losing highly skilled smaller credit union executives to middle-sized CEO roles or middle and larger size C-level roles, because they can get compensated that's fairer and have a fairer retirement program. So if we can create some plans that work for those smaller credit unions, I think we can keep some of that talent there. The problem is that many of those folks are like me, a baby boomer, and they're reaching retirement age, and it's going to be hard to fix that in the short term.
Back to the generational evolution.
Yep. Yeah. So then come 70s, and this is, believe it or not, when I joined the credit union business in the late 70s, we started seeing this third generation of general managers. Now, these folks were, this was still a very simplistic credit union world. Regulated, credit unions, S&Ls, banks were all regulated very heavily on what products they could offer, how they could price those products. And credit unions were still held into a very small box of products and services they could offer. But general managers came in. The credit unions got bigger. They started doing things like normalized teller transactions, cash, et cetera. They started expanding certainly to auto loans and other options. And so while they were still a monopoly mindset, they now had management talent that could manage people, that was thinking about marketing, that certainly, and this was the era where technology really started to be implemented in credit unions, and credit unions took a leap over many of the community banks who were still in batch systems and started had online real-time systems, and staff expanded, marketing expanded within the company's realm or within smaller. And you also started to see more and more small communities. Communities, credit unions at that time were contained by regulation to 250,000 or so populations. But you started to see the expansion into the community. You also started to see now this goes back a long time, under Ed Callahan and the NCUA, the ability at that time then to serve multiple companies. That was really the big change, right? You went from single segs to multiple segs at that time. And so that the general managers now that were really into it, that assets had grown over the previous 40 years, that had now saw openings to this new opportunity with serving multiple companies. So if you were a local business that was significant in technology or significant in a local government that didn't have a credit union, now the credit union in your area that served that type of membership could expand to that second company. So this was expansive. It took different leadership, and now you're starting to see the form of strategy, marketing, skill sets internally. This was also the time of hyperinflation and other challenges in financial instruments. And so you started to see finance people be drawn to the industry, be hired by boards, and you see a transition in boards, which is really important to this management growth strategy, is that they started to govern rather than operate. And the largest credit unions in the country today, I think you can go back to that point in time where those boards transitioned to a strategic and governance model versus an operational model. And so all of that happened in this sort of third generation of leaders. The fourth generation of leaders is now comes 80s, 90s, early 2000s. And now these folks are, it's much less of a monopoly mindset. It is executive leaders, right? So you now have gone from general managers to hiring executives. Many of those grew up within the organizations. So they just happened to be talented. You started to see many more people with degrees being leaders. But the important part now is the regulations open up to multiple products. In the early 80s, Reagan came in and broke down the rules between what organizations could do. So now 70s and 80s, you see checking accounts and certificates and mortgages and credit cards. And all of those businesses at the well-run credit union started to need different leaders, had to have more sophisticated marketing, needed better technology, had to have the skill sets to manage risk. All those pieces started coming into the organization. Still, a monopoly mindset was deeply seated, meaning they served communities that they knew, they served segs that they understood the risk in lending to. Still a lot of only A and B lending, so there wasn't a lot of risk that was being managed on the balance sheet. But it was a diverse business now. It was multi-product, multi-market, multi-segs anyway, and starting to grow in marketing, technology, risk management, and other skills within the organization.
Now, how did the blow-up of S&Ls impact credit unions?
Sure. So I think any of those times, whether it was the melting away of the savings banks or the mutuals or the blow-up of the S&Ls, in each of those cases, they were community or local-minded, and credit unions were able to step in. Specifically in the S&L situation, credit unions quickly adapted, and it was this sort of fourth generation of management that did it, that jumped onto mortgages, right?
Right,
so
because S&Ls had something of a monopoly of mortgages.
Correct, right. So credit unions jump into that space, understand the local markets like the S&Ls did, and are be able to adapt their products and move towards that business that had been vacated by the S&Ls. And remember, regional banks at that time, particularly the larger national and commercial banks, there really wasn't, if you think back about the 70s and 80s, early 90s, this is just when banks were acquiring. They were allowed finally to have the regulations to be able to go to multiple states. But they weren't really interested in consumer finance at the time. they were mostly business and commercial lenders. They would come in and out of the retail business model on occasion. So the S&Ls, then the savings banks and the mutuals moving away, all vacated space for credit unions.
I actually did consulting work, not particularly meaningful consulting work, for First Interstate Bank, which was called First Interstate Bank because it was the first interstate bank.
There you go.
And that was in the late 70s, I think I was doing that work.
If you remember, and I'm sure the interstate at that time would mean having a commercial headquarters in each state you did business in. I remember, Chase's acquisition or Citi's acquisition to go into Texas or Florida, and they had an operational center there because that's what the rules were still about.
Right.
So market starts to open up, as you described. Management now is brought in to have more talent to manage so many of these disruptions, but also opportunities. And on a regulatory basis, not only do the walls start falling on product mix, but in early 2000, and Bethpage happened to be the organization that helped lead this charge, the community charters now become significant opportunities. They had been significant opportunities in several states, particularly California, and in the 90s, but on a federal basis, the NCUA rules in 2002, 2003, that credit unions can go over a 1 million person community. So now you start having the formation of really larger community organizations. And this is where you see a switch in strategy. And I think it's this fourth, fifth generation of leadership that starts to think about growth for growth's sake, something that's still uncomfortable for smaller credit unions today, but well received by almost all large credit unions. The idea of expanding so that you can not only serve those original groups that you were connected to, but you diversify your risk, you evolve the business model, you have different products to offer different economic cycles. And with all of that, you need skill sets. And so the leaders now are better educated. They are more diverse, meaning they come from different levels in financial organizations, including banks, that you start to see commercial lending portfolios grow. And so now you're starting to see a management of companies, right? And I think the credit unions that we talked about earlier, the top 50, all started to really understand the need for that type of executive management. And then I think really importantly is this next generation that has followed my demographic's retirement, which you've seen so many of over the last couple of years, is now they've taken that to a different level, right? Now they've become regional and super regional organizations. There are probably 3 or 4, maybe 500 credit unions that have national reach right now with foundations, associations, or true national charters. You have leadership, well-educated MBAs across C teams that are thinking about digital and data and technology and fintech partnerships. So this new generation gives me such great hope because they are moving the model in ways that we haven't seen it before. So you see this generational change. And by the way, Filene put out some information at the conference last week. Unbelievably, in the last 18 to 24 months, 92 of the approximately 550 credit unions that are over $750 million in assets have new CEOs.
Wow.
92, 25%, right? 25%.
That's probably the generational change.
It is absolutely the generational change. But with that generational change has been new talent, right? The folks that are thinking different, even if they grew up within the credit industry, you see this all the time. Those are the folks that have been thinking about what it is to be a digital and data organization, what it is to have multiple markets, what it is to be able to have strategy around those things. So now, finally, you see this breaking down of this monopoly mindset to a full strategic thought process and growth strategy around how to move into major markets and grow in major markets. I think there's great hope and great success coming for the industry because of that. But it's been that 5-6 levels of management, and we're now into this next generation that I think is going to really matter and really multiply our business.
The business will change, but that's a good thing because it has to change.
That's it.
And I think one thing that has changed significantly is not too many years ago, if we surveyed credit union CEOs and asked, how did you get involved with a credit union? The answer would be, I started as a teller part-time when I was in college. You don't hear that as much anymore.
That's right. I that's my story, right? I started as a part-time teller in college.
You're in the generation where they all did, Kirk.
That's right. That's right. And because we didn't know anything about credit unions, but when we found them, we loved them, right? We loved them not only because of their cooperative spirit, because of the opportunity in the business, but also, frankly, I only speak for myself, not for the rest of the people. It was a unique opportunity to grow in an organization, right? If I had landed at a local bank, I would have never had the opportunity that I had coming at that time at being at the right place at the right time at Bank Fund staff and then Bethpage.
That said, one thing I believe is that to be a successful teller, you need a certain kind of personality. I would fail as a teller miserably. On so many levels, I would fail. For one thing, if the cash drawer was not balanced at the end of the day, I'd say, hell, okay. I'd reach into my wallet and say, here's 20, we're even, call it a day. That's not going to work as a teller. So by channeling tellers, you're channeling a certain kind of personality.
But I'm gonna go in a little bit of a different direction. I'll bet you, and I know it's true of me. I will bet you that it's true of most everyone that I've spoken to that said so. We were miserable tellers.
Oh, okay, good.
So we either talked too much at the teller line, we were too social, or we didn't balance to the penny every day. That was not so. They were kind enough to quickly move us to member service or to someplace else within the organization. There is certainly a mindset about being exact and procedural. It's not necessarily the right mindset to be strategic and growth oriented. And sometimes they intersect beautifully, sometimes not so much. But really interesting, Robert, and I don't have the data on this. We should try to figure this out one day. But I would bet you in those last two, that fourth and fifth generation that we talked about, not this last generation, the sixth generation, but the fourth and fifth generation, so many of the leaders grew up from within the organization, part-time tellers, just as you described, but also many of them grew up from the finance side. You see less and less of that today because it's less about balancing as a teller and balancing the books and managing risk down as it is in managing risk for the opportunity and understanding strategy, brand, technology, digital data, and growth. And really important, cultural transformation. How to motivate a culture, how to ensure that the organization has its member value creation as well as its organizational value creation. And that requires different types of leaders.
Now let's switch to talking about the budgetary impacts.
Yep.
You made the point, and I think it's certainly true, that skyrocketing employee salaries, not just in the C-suite, but across the board, are now impacting credit unions.
Yeah, we're seeing significant labor costs increases today, and I don't know the detail on this. I've asked a few friends to sort of weigh in on this. Robert, today was the third quarter release of the top 10 credit union performances. And what you'll see is that 7 of those top 10 are performing very well, strong ROA and performance. And 3 of them have lower ROA than you would have expected. And so there'll be some reasons why that might have occurred. But what you see in the analysis of it is significantly increased operating expenses that is powered by this expense of labor. So the CEOs and CFOs that I'm talking to are all deeply concerned about labor costs. I've talked to 2 credit unions recently to give you, and now this may be outliers, I don't know yet. I'll know more after this conference and a few others. But where they are expecting total expenses. And remember, labor is probably 60% of this. Total expenses to go up around 20%. Now, that is additional hires. It's expenses for new other things as well, but everything is going up because of inflation, right? Energy, marketing expenses, whatever, technology expenses, all of them are going up. And yet their expected growth, so their expenses are going up by 20%, expected growth by less than 10% for 23. That's a formula that doesn't work for very long. It can work in the short term if you have plenty of capital. So you have expense growth that's going out there, primarily fueled by labor growth that is now at the 5.5% to 6% salary increases, plus new employees coming in, plus sometimes bonuses and other pieces to that puzzle being put in. So you have all of this. You mentioned senior team members. CEO salaries, according to Q's, went up 15% year to year. And C-level talent over the last 5 years has gone up almost 10% per year.
And importantly, that's before today's inflationary spiral. That
Correct.
15% number was back when typical employees were getting a 2% pay raise, and they were happy with it.
That's right.
It's 15. It's like, wow.
And that has to do with asset accumulation. And, there are a bunch of factors to that, but you're absolutely right. So you're seeing compensation expense across the board being significant and larger than the growth of the company. So there is a simple strategy that I think works very well at credit unions. Is if you can grow your assets more than you grow your expenses, you decrease your expense percentage of your business, and you can perform at a very high level doing that. When it's the opposite, it's problematic because you have to take that value away from dividends or loan rates or fees. You have to make it up in some way because you've got to maintain an ROA that allows you to grow. There is an inverse and negative effect that expenses are having on the business model right now. And again, you can manage through that in the short term, but it will add up quickly. And I think so you'll start seeing, and if we haven't seen already, a few things to occur. One is the CFOs and the boards will react to those increases in expenses in a way that starts to pull away funds from other areas. You typically see cuts in community and marketing, maybe new branches, maybe expansion in new projects. But somewhere that money is going to be pulled away from to pay for compensation and allow for the organization to maintain a strong ROA. The second thing that you'll see, I think, is that credit unions will start to slow down their growth. I don't think that that's a necessarily productive strategy, but that is what typically occurs. And in that slowing down of their growth, they will do things like not expand to new markets as aggressively, not market, as I said earlier, not build their brand as aggressively. Two things that I would say from my experience to think about for each credit union. First is there are lots of opportunities with fintechs and with global resources and other ways to start to manage your expenses. So there are the things that banks and other companies have done forever. And that is to move some operational expenses to lower costs. You can see that through virtual ways today, meaning that Long Island, if you're doing business on Long Island, you could have mortgage servicing people in Alabama, right? Or you could have mortgage servicing people in India. The great strength of credit unions is collaboration. So the opportunity to put together CUSOs to work on backroom operations, I think, has always been around ever since PSCU and Co-op to some of the organizations we created at Bethpage and OTS and S3. There are opportunities in the marketplace to do that and cut expenses. Third, there is the opportunity to partner with fintechs and let them do some of the businesses that are important to you, but with either investments in that fintechs or in operating in ways that are in partnership with them, you can create an environment where they can help serve your members or provide a particular product. And then lastly, it is the idea of, and I think this is probably crucially important to most credit unions, but not often executed on. Credit unions' balance sheets have less risk on them than any of their competitors. Fintechs, banks, community banks, because of our sort of risk adverse culture, really serves us well in a down cycle. CUNA came out today and is predicting a recession in the first half of next year. Credit unions can understand the risk on their balance sheet. And once they have a depth of understanding and understand the community and how their community is reacting to the economic consequences, can accelerate coming out of a recession and grow faster than anybody else. And that's the time to spend money and to build brand and to move resources forward. So there are some strategies that you can use. The more strategic you are, the more you're thinking about scenarios of the future, and the more you have diversified bets, fintechs, QSOs, outsourcing, new technologies to cut expenses, the better off you're going to be.
Now, I think that a lot of the trouble that credit unions had in the 2008 recession, certainly not all credit unions, but many credit unions, is due to the failures of the corporate credit unions, as opposed to due to the failures of the credit unions themselves. Does that make any sense to you?
Sure. Yeah. And I think that speaks volumes to that last point that I mentioned, is that
the credit unions didn't have much risk on their books, except for these wonky corporate credit union investments that the credit unions themselves probably weren't tracking that well.
There's no question all of that was true. And I was guilty of it at Bethpage. So I'm not pointing fingers at anybody. There were a couple corporates that had more complicated investments and a higher percentage of those complicated investments to derivatives and other means than Lehman and some others that went down. It was problematic. But at the end of the day, those corporates went down, and that cost credit unions a lot of money. They certainly lost value in real estate and mortgages if they were, but almost every credit union did just great, right? One important thing to think about when boards talk about or executives talk about who don't want to grow, about how do credit unions don't want to take on too much risk, growth for growth's sake's bad, any of those old adages. Think about how almost the entire industry, with the exception of a very few credit unions, did just fine during the worst recession in 100 years, right?
Right.
And so if that's true, and I don't believe credit unions have significantly increased the risk on their balance sheet, it'll be interesting to see those that did a lot of loans with unsecured fintechs, how those evolve. Certainly, there's more commercial loans on the balance sheet than there were, but it's still small percentages. There's a lot more indirect auto loans, so we'll see how those all perform. But at the end of the day, any credit union I talk to hasn't significantly increased the risk that they're putting on their balance sheets.
And at least some sophisticated credit unions that I've talked to in recent years have really backed away from indirect auto loans simply because they weren't performing. Not that the failure rates were significantly higher. It was a low compensation loan, and there was no relationship that was
That's
built.
it. You got it. But at the same time, those that did continue to grow auto loans, and particularly indirect autos, have gotten better at using the data and are better understanding the risk that's going with it, and are doing a job. Now, there will be some exceptions, right? Every downturn does reveal some weaker teams and weaker strategies, and we'll see some of that. But credit unions will be just fine and should take it as an opportunity to, as they see an end in sight of the recession, to accelerate through it and build brand.
Now, let's go back to compensation.
Yep.
Have you ever been in a time where 2 years ago, if we walked around to the fast food outlets in Phoenix looking for work, they might have offered us work at minimum wage in Arizona, which is like $7.50 an hour. Today, we can go with no experience. We'll probably get paid $15 an hour by those very same places. That's 100% increase in 2 years. And It's not just the new hire. So if I've been working there doing burgers at $8 an hour, I'm going to say, hey, what about me? Because otherwise, I'm going down the street to Burger King, man. They'll pay me $15.
And if you want to be a new teller at a credit union, $20 an hour.
Exactly. Have you ever been in a period with that acceleration of salaries? I can't remember anything this fast.
No, I can't imagine. I going back all the way to the 70s and maybe mid 70s. Now that was before my time. There might have been some of that in that hyperinflation.
Mid 70s. I was working in the mid 70s. And yeah, it was pretty customary, even if you were a marginal employee, to get a 10% pay increase.
Okay.
But not 100%.
No, I don't think there has been a time, and that's the demand for labor that we've seen, that there's lots of macro trends that have caused that. And that's my concern with where we spoke a few moments ago about the expense challenges for credit unions. Yeah, I do see, you've just made a point that I think is critical for everyone to think about. And you do see it in credit union cultures more than any place else. And that is the cascading effect of higher salaries. Right? Credit unions are very prone, want to, and often and almost always do two things. They would increase everyone's salary because of those bottom levels that came up, at least throughout the operational organization, maybe not the executives, but the rest of the operational organization. And two, they are very hesitant to fire people. And so if the mortgage operation dies down, they may move some of those people to do home equities or other loans, or they may just allow them to stay at excess capacity and maybe, as attrition occurs, fill positions, but not good at cutting expenses. That's great for the culture. It's great for the team. It is difficult when you have escalating costs, as you just identified.
Now, another topic that you discussed in the last podcast, but is relevant now too, is the executive team expenses at bigger and better credit unions is vastly higher than it was a generation ago. And that's because there are more people in the executive team. They're also getting paid more, but you've gone from an era when maybe there were 3 or 4 executives, senior executives, at even pretty big credit unions, to ones where there are 10 or 12. And each of those people expects to be well paid, and they should be well paid. But this really has an effect on the overall payroll.
All true, right? There's if you take a 600 person, 700 person, 1,000 person credit union, that spreads out pretty thinly. But to your point, they're double the number of executives at larger credit unions these days. And we talked about that last time, but it's chief risk officers, chief legal and compliance, member experience, diversity, digital data. All of those are adding roles. And particularly in some of those, legal, digital, data, even risk, certainly while there had been CIOs in place, the cost of CIOs have significantly increased in the marketplace. Those folks are in high demand. And so you're adding positions, but you're adding positions that are high in demand. And so that's escalating costs.
Oh, I talked with a guy who told me he knew Silicon Valley companies that were poaching CIOs from credit unions in the Midwest. And he said this was unthinkable 5 years ago. Absolutely unthinkable. You hired a credit union CIO? Come on.
Right, the inverse, right? The inverse of whatever happened. We're talking to a credit union that was in $1 billion range. And I might have told this story last time. They were looking to hire a chief risk officer. They thought they had the person all bottled up. Well, a regional bank came in and offered the person $100,000 more, 50% more than they were getting paid at the other organization.
Quite possibly with some stock options involved too.
Exactly right. Yeah, that might have been total comp. I don't know the base, but it tells you what the demand for talent is at the top levels. Now, that's not going to change, in my opinion, even in a recession.
Oh, it's going to get harder. Any idiot can run a credit union in the good times. Well, I'm exaggerating.
I wouldn't go that far, but yeah, I hear you.
But now, in this environment, it's going to take real talent to navigate through the dangers.
Yeah, but and you're looking at and you mentioned it earlier, a humongous demographic shift. Right, the baby boomers retire. They're still going to retire. Matter of fact, if their retirement plans are in good shape, 401ks, et cetera, they're going to retire sooner than later than have to fight through a recession. So the demand for that talent just escalates. And that's across all businesses. It's not just credit unions.
Oh, I think the baby boomer generation at credit unions went through the 2008, 2010 period. And in their minds, that was the last big war they were going to have to fight. And now we have a new one looming. And
it's,
do you really want to fight this, or do you want to just go play golf and drink gin and tonic?
right.
It's actually not a hard choice.
And it's, I think maybe even an additional realization occurs, and I hope it occurs. And that is that if you're in this game of being the CEO or C-level, understand that every 5 years, maybe 7, maybe whatever number of years, but something around that, you're going to deal with a world-class crisis, right? COVID, recession, '08, or now the digital data transformation, whatever those things are that are so disruptive to the business model, that if you're not up for the learning and change and the expansiveness and the new business models, it may be time to retire, right? Because it's not the quiet times of from the relatively quiet times from the 80s through 2010, 2020 that happened. Sure, you can talk about the Great Recession, and that was extraordinarily problematic. But overall, that whether it was interest rates continuing to go down, or whether the reasonably slow pace of growth in credit unions, or many other things, it was an adaptable level of change. We're in a historic level of change, an industrial revolution of digital and data, and a demographic shift simultaneously, along with innumerable variables in the national and global economy. You got to be up for something that is substantive change in strategy every few years. And you've seen it from COVID to this growth, the probability of a recession coming forward, and humongous increase in interest rates, more than we've seen in 20 years. You've got to be adaptable, and you've got to be learning and expansive if you're going to be able to be successful.
And you just look at the changes in technology, and the pace gets faster and faster and faster.
With, how many firms do you and I talk to on the fintech space? And you look at Members Development Corp and Circle Funds Growth, or CUNA Mutual's venture fund. All of those are exponentially increasing the technology available to credit unions.
Yeah, and that's going to be a real challenge for credit unions, particularly in the looming possible recession. If they retard their adoption of new technologies, that might save a little money, but it might also lead the way to longer-term business failure.
That was my point, and I think you articulated it far better than I did, is that you can cut expenses in productive ways. You can cut expenses by using global or regional resources at a lower cost to do backroom operations where you're not adding value to the member interaction. Think about remote deposit capture transactions, or collections, or accounting services. Those kind of things can be handled almost anywhere on the globe effectively at a lower cost, because you're not directly adding value to the member. But you cannot cut investments in new technologies when you're seeing such massive changes in the skill sets to use digital and data, and changing the culture to be effective in business intelligence and in marketing and brand positioning. Those are things you have to continue to invest in, and you have to find ways during economic downturns to cut the other expenses. It is a changing world. None of us will be completely right. Sometimes historical perspectives are accurate. Sometimes they shade things. But ultimately, all of us continuing to talk about it and ask questions will get us farther along. The compensation is a strategic tool, just like all the other things we're talking about. And if you don't use it effectively, if you use it either at too low a threshold, not paying enough, or if you overpay without connecting it to growth and performance, you will not do as well as the organization that aligned those things and understands the market conditions. And hopefully we do a little bit of that.
The big banks have known that for 2 generations of leaders.
That's right.
And they've lived with that code. And only now are a handful of credit unions really coming to grips with this. And some are. But right. to most credit unions, this is like, huh? The big banks knew that this was essential to their competitive abilities. And credit unions have to accept that same principle. Yeah, talking about money's ugly, but sometimes you got to deal with it, man.